Picture a Saturday morning. The parking lot is already full by 9. You roll your cart past a pallet of 42-inch televisions stacked like sandbags, past a rotisserie chicken cart getting refilled in real time, past a woman handing out a sample of something you didn't know you needed until this exact second. You fill a cart with things you didn't plan to buy, you spend more than you meant to, and somehow you leave feeling like you won. Now flip the picture. You're not the customer anymore. You're the person who has to make this building profitable, quarter after quarter, in an industry where most competitors are bleeding out, closing stores, and blaming online shopping for margins that keep shrinking every year. You're the one who has to explain, to a boardroom or a bank, why a business that deliberately refuses to mark its products up very much is somehow still one of the most valuable retail names on earth. And here's the part, almost nobody walking those aisles has ever stopped to ask, what is Costco actually selling you? The stuff in your cart, or something else entirely, something you already paid for months ago without noticing. Owning Costco is not one thing. It's at least 3 completely different businesses hiding behind the same red and white sign. There's owning shares of Costco Wholesale, the public company, traded on the Nasdaq, valued in the hundreds of billions of dollars. There's owning the real estate a Costco warehouse sits on, because in a meaningful number of markets, Costco doesn't own that building outright. It leases the ground and structure from a developer, a private landowner, or a real estate investment trust, and that ground lease is the actual asset changing hands. And there's owning a business that supplies Costco, a manufacturer, a co-packer, a Kirkland Signature production partner, whose entire company rises or falls depending on whether a Costco buyer keeps signing off on next quarter's purchase order. 3 very different doors into the same empire. 3 different price tags to walk through them. 3 different timelines before any money comes back. And 3 completely different ways to either get rich or get wiped out, depending entirely on which door you actually chose to walk through. Start with the stock, because the price of admission alone tells you something is strange here. A single share of Costco has, in recent years, traded well north of $800, meaning buying even a modest handful of shares can run you into the tens of thousands of dollars before you own anything close to a meaningful stake in the company. That's an expensive ticket for a retailer whose core math looks almost irrational on paper. Costco's gross margin on merchandise is reported to be capped, by internal policy, at roughly 14%, and, by some reporting, capped even lower on its own Kirkland Signature private label, the products Costco actually controls from source to shelf. Compare that to a typical specialty retailer marking goods up 30, 40, sometimes 50% over cost, and the picture gets stranger. Costco is, by design, one of the thinnest margin retailers in the country. So why does Wall Street price the stock like one of the most valuable retail businesses on the planet? Costco has, for years, traded at a price-to-earnings multiple well above traditional grocery chains and discount retailers, some of which trade at a fraction of that valuation, despite generating comparable or even larger total revenue. Investors aren't paying up for this year's thin merchandise margin. They're paying up for the belief that a customer base renewing its membership at rates most subscription businesses would envy is worth more, long-term, than a retailer squeezing an extra few points of markup out of every sale. That contradiction is the whole story. There's a second door almost nobody outside commercial development ever thinks about, the real estate angle. In a lot of US markets, the land and the building under a Costco warehouse belong not to Costco, but to a developer or institutional landlord, who then signs Costco to a long-term ground lease, frequently 20 years, sometimes with multiple renewal options stacked on top. Being that landlord is, on paper, one of the calmer bets available in commercial real estate, Costco almost never defaults, almost never breaks a lease early, and its mere presence in a shopping center reliably pulls in other tenants and pushes rents up across the whole property. But the entry price to become that landlord is not small. Assembling 10 to 20 plus acres in a location Costco actually wants, which usually means a location where land is already expensive precisely because Costco wants it, can run into the tens of millions of dollars before a single foundation is poured. And the timeline is brutal. Entitlements, zoning approval, environmental review, and negotiation with Costco's real estate division can take years before rent ever starts flowing. Then there's the vendor path, arguably the most brutal and the most quietly lucrative of the 3 doors. To get a product onto a Costco shelf in the first place, a supplier typically has to prove it can deliver enormous volume at a price point Costco's buyers consider acceptable, at margins Costco controls, not the vendor. Costco is famous, and in supplier circles feared, for calling a manufacturer directly and telling them a product's price has crept up too far, and that they need to bring it back down or lose the shelf space entirely. Full stop, no extended negotiation. For a small or mid-size manufacturer, landing a national Costco contract can multiply company revenue overnight. Losing that contract, or getting delisted for a pricing dispute, can gut a company just as fast, sometimes inside a single fiscal quarter. This is not a business you casually step into with a good product and a nice pitch deck. It's a business that, once it says yes to you, quietly restructures your entire company around its terms. Your factory lines, your packaging, your cash flow calendar, all of it now built around one buyer's calendar. And underneath all three of these doors sits a fourth relationship most people never even think to separate out: Costco's own private label, Kirkland Signature. On paper, Kirkland is just another brand on the shelf. In practice, it functions almost like a fourth ownership category entirely, a product line Costco controls end to end, often manufactured by the very same name brand suppliers competing against it on an adjacent shelf, just without the second company's logo or marketing spend attached. A supplier who agrees to produce a Kirkland-branded version of their own product is, in effect, choosing to compete against themselves at a lower price point, in exchange for guaranteed volume at Costco's scale. It's a strange, quietly ruthless arrangement, and it's one of the reasons Kirkland Signature is reported to carry some of the thinnest margins of anything in the store, because the entire point of the label is proving, item by item, that Costco's own version is the better deal. So let's actually price out each door, because the entry costs diverge fast once you look closely. Buying a controlling or even a meaningfully influential position in Costco stock is, realistically, a game reserved for the largest institutional funds and the wealthiest individual investors. The kind of stake that would actually move the share price starts in the billions of dollars, not the millions, given the company's total market value. Even buying in modestly, purely to hold shares long-term rather than to influence anything, requires accepting a valuation multiple that assumes near-flawless execution for years into the future. You're not just buying a retailer, you're buying the market's confidence that thin margins and steady growth will keep compounding without interruption. Buying the land and building under a single warehouse, by contrast, is a different order of magnitude. Commercial developers who specialize in this asset class describe all-in costs, land plus construction plus site work, somewhere in the $20 to $40 million range depending on region, a real number but one a well-capitalized private investor, family office, or right can genuinely reach. That figure typically breaks down into three rough buckets: the raw land itself, which in a location dense enough to interest Costco can already run into 8 figures before anything is built; the building shell and site infrastructure, sized for a footprint that can exceed 150,000 square feet plus parking for well over 1,000 vehicles; and the soft costs, architectural work, permitting, environmental studies, and the years of back and forth with Costco's own real estate division before a lease is even signed. And becoming a qualified national Costco vendor doesn't require buying anything in a traditional real estate sense at all. It requires already owning or building manufacturing capacity that can reliably produce, say, 100,000 units a week without missing a delivery window, which in practice usually means you've already sunk millions of dollars into a factory long before a Costco buyer will even take your call. On top of the factory itself, a serious applicant typically needs third-party food safety or quality certifications already in hand, a logistics operation capable of hitting Costco's regional distribution centers on a fixed schedule, and enough working capital to produce and ship a full order before the first payment ever arrives. Here's the hidden layer of cost that almost nobody accounts for going into any of these three doors, the part that sits underneath the sticker price and only shows up once you're already committed. Buy Costco stock, and the infrastructure you're really buying into is a corporate culture built to reinvest in employees and low prices before it reinvests in shareholder payouts. Costco has a long, well-documented history of paying above-average retail wages and offering benefits that outpace most of its competitors, a cost structure that keeps turnover low but also keeps the operating margin permanently thin by design. Buy the real estate, and the infrastructure cost hiding underneath the land price is the site work itself. Utility hookups sized for a building that runs a pharmacy, an optical center, a tire shop, a food court, and a fuel station simultaneously, plus the truck court and parking ratio Costco's real estate team will demand, before they'll even sign the lease, easily adding millions on top of raw land cost. Buy your way in as a vendor, and the infrastructure cost is compliance. Costco's own supplier standards around food safety audits, packaging specifications, and delivery reliability windows, all of which typically require a dedicated compliance function inside your company before you're allowed to ship a single pallet. The daily cash flow mechanics matter just as much as the sticker price, and this is where the timing mismatch shows up. The same structural mismatch that shows up across almost every ownership category in this format, just wearing a different costume here. A Costco landlord collects rent monthly or quarterly under a fixed lease, regardless of how good or bad a season Costco itself is having at that location. Steady, predictable, almost bond-like income. A Costco vendor, meanwhile, gets paid on Costco's schedule, not their own, often with payment terms stretching 30, 60, sometimes 90 days after delivery, meaning the vendor has already paid its factory workers, its raw material suppliers, and its shipping costs weeks or months before Costco's check actually clears. For a smaller manufacturer riding on thin margins to begin with, that gap between money going out and money coming in can be more dangerous than any pricing dispute. Companies have gone under not because their product failed, but because they couldn't survive the cash flow gap between shipping to Costco and getting paid for it. Picture a mid-size food manufacturer that lands its first national Costco order, a single purchase order worth several $1,000,000, more volume than the company has ever produced in one run. The factory has to buy raw ingredients, run extra shifts, and pay for freight to Costco's regional distribution centers, all before a single invoice is paid, meaning the company effectively has to finance its own biggest win, often by taking on short-term debt, just to survive the gap between delivering the order and collecting on it. Here's the mechanism that explains why Costco itself makes money at all, the thing almost nobody standing in that parking lot has ever stopped to consider. Costco does not primarily make its profit from the television, the rotisserie chicken, or the 40-pound bag of rice sitting in your cart. Its core profit engine is the membership fee, $65 a year for a Gold Star card, or $130 for an executive membership, figures that went up for the first time in 7 years in September 2024, and now apply to something in the range of 52 million member accounts worldwide. Executive members also earn an annual 2% reward on qualifying purchases, capped at $1,250 a year as of the most recent fee update. A reward generous enough that a household spending several $1,000s annually at Costco can effectively earn its entire membership fee back, which is precisely the point. It keeps the highest spending, most loyal members locked into the upgraded tier year after year. Membership fee revenue sits close to, and in a number of recent fiscal years has actually exceeded, Costco's entire operating income generated from merchandise sales combined. In other words, the shopping experience itself functions almost like a service Costco provides to justify charging you rent to walk through the door in the first place. The margin on the products is thin to the point of being close to symbolic. The real transaction already happened the day you renewed your card. Everything after that is Costco simply proving it was worth the $65. And membership fees aren't the only quiet profit layer running underneath the merchandise. Walk past the pharmacy counter, the optical center, the hearing aid center, the travel booking desk, and the gas station out front, and you're looking at a collection of ancillary services that mostly exist for the same reason the hot dog does. Not to be a major standalone profit center on their own, but to make the membership card feel indispensable in more parts of your life than just grocery shopping. The gas station in particular tends to run on margins even thinner than the 14% ceiling inside the warehouse, often priced to be the cheapest option in the area on purpose, because a member who fills up at Costco once a week has one more reason never to let that card lapse. None of these services need to be individually profitable to be strategically essential. They only need to keep you renewing. Which brings us to the hot dog. Costco's food court hot dog and soda combo has been priced at $1.50 since the 1980s, and in 2024, when the company's own new chief financial officer was asked directly on an earnings call whether that price would ever move, the answer was no, it's staying exactly where it is. The story that has followed this decision for decades inside the company is that Costco's co-founder once told his successor, in no uncertain terms, never to touch that price. Whether every detail of that exchange is remembered with perfect accuracy after all these retellings almost doesn't matter, because the frozen price has become the clearest possible symbol of the entire business model. It is designed to lose a small amount of money, on purpose, forever, because its only real job is to make you feel like the membership card in your wallet was the smartest $65 you spent all year. The hot dog isn't the product being sold. The hot dog is the advertisement for the membership, running 24 hours a day at the front of every warehouse in the country. For the real case study behind all of this, you have to go back to where Costco's entire philosophy actually came from, and it starts with a name most shoppers have never heard. In 1976, a retail entrepreneur named Sol Price, who had already built and sold one discount chain, opened a members-only warehouse in San Diego called Price Club, built on the idea, radical at the time, of selling in bulk to small businesses and individual members at razor-thin markups, with the entire operation funded by an annual membership fee instead of a heavy retail markup. A young executive named Jim Sinegal worked directly under Price during this period and absorbed that philosophy from the inside. In 1983, Sinegal co-founded Costco Wholesale in Seattle, built explicitly on Price's low-margin, membership-funded blueprint, but scaled it further. Bigger warehouses, a wider category mix, and eventually its own private label built around trust rather than brand marketing. By 1993, Costco and Price Club, the students' company and the teachers' original company, merged into a single entity called Price Costco, which was later renamed simply Costco Wholesale. The company Sinegal, built on Sol Price's original idea, went on to become one of the largest retailers on the planet, all while keeping the exact promise Price had made decades earlier at that first San Diego warehouse. We will not mark this up more than we absolutely have to, because your trust, not your margin, is the actual business we are running. That same low-margin, membership-funded blueprint has since traveled far beyond Seattle. Costco has expanded into markets including Japan, South Korea, Taiwan, Australia, the United Kingdom, Spain, France, and Mexico through a long-standing joint venture, and in 2019 it opened its first mainland China location in Shanghai, an opening so aggressively popular on day one that the crowds and traffic congestion reportedly forced the store to close early and temporarily cap the number of new memberships it would issue. Each new country adds its own version of every risk already on the table here. Different real estate rules for the landlord side, different supplier relationships to rebuild locally, and an open question, in every new market, of whether members there will actually renew at the rates Costco depends on back home. So why do sophisticated, extremely wealthy investors keep buying into and holding a company that brags publicly about capping its own profit margins on purpose? Charlie Munger, Warren Buffett's longtime investing partner at Berkshire Hathaway, sat on Costco's board of directors for decades and repeatedly, on the public record, called it one of the best-run companies and strongest cultures he had ever encountered in his entire investing career. Not despite the thin margins, but specifically because of what that discipline signals about the people running it. For a long-horizon institutional investor, that discipline is the actual asset being purchased. A retailer that refuses to raise margins even when it easily could, quarter after quarter, decade after decade, is a retailer that has built something far rarer than a strong earnings report, a customer base that renews at rates most subscription businesses in any industry would envy, almost regardless of what the broader economy is doing. That renewal reliability, far more than the hot dog or the rotisserie chicken, is what a patient shareholder is actually buying when they buy Costco stock and refuse to sell it. Picture the good year. Based on Costco's total reported company revenue spread across roughly 900 warehouses worldwide, an average location can bring in somewhere in the neighborhood of $250 to $300 million in annual merchandise sales, plus its proportional share of membership renewals, which convert to close to pure profit since there's essentially no cost of goods sold attached to a membership card. In a genuinely strong year, high renewal rates, low theft and shrink, smooth supply chains with no major disruptions, and a healthy push of members upgrading into the higher margin executive tier, that single warehouse can be one of the most efficient retail boxes operating anywhere in the country, moving enormous physical volume on wafer-thin unit economics that still add up to real profit purely because of scale. Now picture the bad year, because this is where the structural fragility actually shows itself. A supply disruption spikes input costs on a major category Costco can't instantly pass along to members without breaking its own pricing promise. A regional competitor opens nearby, or a wave of grocery e-commerce substitution quietly steals foot traffic away from the food court and general merchandise aisles. Theft and inventory shrink eat into a margin structure that had almost no cushion built in to begin with. Because a 14% markup ceiling leaves almost no room to absorb a bad quarter through price alone. Even a small percentage point slip in gross margin at that scale of revenue can erase a meaningful share of the warehouse's entire annual merchandise profit that was thin to begin with, inside a single underperforming stretch, leaving membership fee revenue to quietly carry the location's numbers almost entirely on its own until conditions recover. Layer the landlord and the vendor back into this same bad year, and the picture gets worse for them specifically, not just for Costco. If foot traffic at that warehouse genuinely declines over a period of years rather than one rough quarter, the landlord's leverage at the next renewal conversation weakens. A 20-year lease that once felt bond-like starts to look like a bet on a single anchor tenant's continued strength. And a vendor whose Kirkland Signature or private label contract gets renegotiated downward during that same rough stretch doesn't get to spread the pain across 900 warehouses the way Costco corporate can. They absorb it entirely inside their own factory's cost structure, often with no comparable customer able to replace that lost volume on short notice. That's the real synthesis sitting underneath everything in this video. The merchandise pays Costco's bills, but the membership card is what actually makes Costco rich. Every rotisserie chicken, every $1.50 hot dog, every pallet of paper towels stacked to the ceiling exists for one purpose: to make you feel like the $65 was the smartest money you spent all year, so that next September you renew without a second thought, without ever running the math on what you actually paid for. That single mechanism is exactly why the three doors into this empire, the stock, the ground lease, and the vendor contract, all ultimately depend on the same fragile thing staying intact: your willingness to keep paying the fee before you've bought a single item. Every ownership path into this business, however different the entry price or the day-to-day risk, is really a bet on the same underlying question. It isn't whether Costco can sell you a television or a chicken at a fair price. Almost any retailer can do that in a good year. It's whether 52 million households keep believing, year after year, renewal after renewal, that the card in their wallet is still the best deal in retail, long after the novelty of that first Saturday morning cart has worn off. So the next time you're standing in that parking lot, cart a little too full, checking your receipt against the total already forming in your head, remember that you didn't really pay for what's sitting in the cart. You paid for that, in full, months ago, the day you renewed the card in your wallet. Everything else that happens inside those doors, the samples, the rotisserie chicken, the $1.50 hot dog you'll eat on the way out, is simply Costco quietly proving, aisle after aisle, that the fee was worth it.